Hello and welcome to another live trading session. Today is September the 6th. Exciting day. We're going to take a look at what's going on in the market and then see if we can put on a second part of the UOTS 2.0 strategy, the second naked put, and then we'll talk about it a little bit more into detail and some ideas and things like that. So it's worth taking a look here just to see briefly what's going on in the market. And as you can see, there's a big red candle right here today. We are halfway down where we were like a month ago or something in beginning of August. Certainly, there is more room to go down. So I just want to make sure that it's clear. I'm probably going to be putting on another naked put today, but that's not because I'm bullish on the market at all. I mean, if anything, if I was a betting man, I would say, well, there's a decent chance that we continue to slide down more than the other way. But that's not why I'm putting the trade on. I'm putting it on because it's part of the plan. We reached that point where there is probably enough premium to be sold here. And with this new strategy, we can carry this trade on. Even if we go into negative with that, we are very under leveraged and we can carry that on. So we just want to capitalize on this increase in VIX and the market pullback. And the funny thing is, I would almost like for the market to really explode to the downside on Monday, Tuesday for another few points and the VIX to go down, because we still have ammunition to go. Even if we put a trade on today, we still have ammunition to go for one more. Obviously, after that next one, I would prefer market to slow down and start reverting. But we don't get to choose, pick and choose when the market is going to go up. And if we miss the boat, then we're going to miss out on that all that premium that's available now. So we need to follow the plan and adjust as we see fit. But for right now, we're going to take a look where we at with this. So let's take a look at the VIX. It seems like a nice, decent pop in the VIX. We're at 23 and change, which is, elevated, not extremely high, but it is elevated. It can certainly go higher. So we'll see what we can do with that as is, and then we'll go from there. So let's take a look at the account here first. The funny thing is we are actually up on the day. Now, to be fair, this is not due to the current strategy. This is due to some leftover put debit spreads that we had from the UOTS 1.0, and those are still alive. They were bleeding money for a month or so, but given that they are negative delta trades, obviously they're bringing some relief here. So we'll see. We might actually be able to cash in on some of them. These are alive for another 14 days. With the longs at 53.60, 53, so in the 5,300 neighborhood, so still out of the money. But then we also have a couple of them here that are 24 days and around 54 strike or so. So, they're bringing a little bit of relief, and hopefully we can cash in on some of those. But that's besides the point. If we were just to look at the naked put, that's part of the strategy, it's right here, and that one is down 400 for the day. Again, we are not closing. There is no stop losses with the strategy. We are carrying on the trade. We are rolling it up. It's less than 1x leverage, so we are ready to take it for as long as it takes. And given that our account is around 48,000, this is less than 1% down on a day when the market itself is down 1.6. So that's good. We like that. So before we go, well, let's go ahead and take a look here and talk about something that futures specific. Now, the account size is not large enough to have portfolio margin which would be ideal, because we would be trading SPY and we would have no issues with rolling option or rolling different expirations and different pricing. And what I mean by that is, if you go here and take a look, the current one, this is the one right here, 54.21. But then the next one, which we are now going to be rolling into, is going to be about 60 points higher. So, well, that's unfortunate because we're going to have to roll our puts higher in order to keep up the premium where it is. Otherwise, we're going to go into debit, and we don't want to do that. So that wouldn't be the case with SPY, but we can't do that now until the account is large enough to do that. So just keep that in mind as we go along. So first thing we're going to do is two things. Today is the expiration date of the original naked put, and we're going to put it out in time until we can get it, we'll get some extrinsic value so that we are safe from early assignment, at least for the time being. And then we're going to take a look at the second naked put, the part 2 of the strategy, which would be the one right here. Now, when we started here, it was 56.15. So we were looking at 5400. Obviously, we're going to have to move that higher due to that rolling in the rolling into next future, which is higher. So we're going to take a look at that and see where we're at. But first of all, we're going to do roll expirations on this one. And let's say we're not going to be able to go probably just 6 days out. So this is going to place a closing order here on this one at 56.35, and then we're going to have to move this one higher up as there will be no there is credit here. That's strange because let me see. Yeah, okay, it shouldn't be any credit. There's no extrinsic value in here. Is this because it's different? Let me see. I think we're going to have to just move it out. I don't think there is going to be any. If we try to close this, I don't think we would be able to get credit for this. So I'm not going to bother with that. I'm just going to go further out in time and get into something like 21, 24. Where is this? There you go. 56.40. Now, this is what I was saying earlier. This would be a debit because of the different strikes, spot price of the future. So if you go up around 60 points, that would be like something like here. So this would put us on an equal footing with the previous one, moving that up and getting some credit here to be able to do this roll. This would put us at 87 delta, still pretty high, and the market obviously would have to come higher up to meet us. But this again, it's starting from the higher position because this is the next month, next expiration future. So let's go here where there's actually some. Let's see, no, credit. We'll try and see if we can get this closed. Obviously, there's a bid-ask spread is a bit on a wider side, so we'll just start here and see where we get winners. We probably have to be patient because I'm sure the liquidity is not great here. That's another thing that would be much better with a SPY, but let's see. So I'm gonna have to work it down. And so let's leave it. Let me see. Mid 29, we're doing 26. So we're going under the mid price. So let's leave it here for a second, and then let's look at the same expiration and look at that naked put that we were going to sell as a second part of the stepping process. The original put was going to be around 5400, but we're going to have to up that 54, so 54 50. These are still things that I need to fine tune a little bit to make it a little bit more mechanical. But again, this strategy allows for a little bit more discretion, so it's not really huge deal one way or the other. We can go here, get $428, which is okay. I think that's already decent, but let's first see if we can close. We want to be in the same expiration. So if we can't do this one here, we'll just go to the next 24 days, I think. Let me just see if we cancel this order and go back here. And the roll expiration will start right here, just quickly, and then go time. Let's go to 24 days. Where is the right here? And we said we're gonna go a little bit up to meet the. It looks like there's a little bit more open interest here, so we might have better luck, even though the bid-ask spread is still pretty wide. So let's go ahead and try at the mid price, and then replace and go a little bit down. And we might also consider, splitting them and doing them separately. But, we're not gonna overthink this. We're just gonna go down. It is what it is, so long as we are getting some credit. Now, we are no longer counting on the extrinsic value of this original put. This one is now more for the intrinsic value. When the market starts pulling back up, we'll get all of the intrinsic value back. Now, we are going to be getting some extrinsic value from the new put that we are selling. And so that's why here we're going to go a little bit further down and try and close this. Yeah, unfortunately, the slippage here is ugly, but we got to do it. It's expiring. We have to September 6th, September 30th, 56. Sorry, guys, I know this is it's not really ideal, honestly, but let's place. Our buying power usage is very, very low, so that's not an issue as well. As you can see right here on our MESs, obviously the put debit spreads are contributing a little bit, but still, this we're talking about 0.4. So nothing. There's no buying power usage. There is obviously SGOV that's using 23%, but we can always sell that. And as I mentioned in the trading plan, the good thing about this is that we can dedicate a larger portion of our let me just see, Martin. Hi, Victor. You could please repeat which CAGR are you aiming to get with this strategy? There is no target CAGR with this strategy. We're just trying to limit the risk to acceptable levels and then extract from the market whatever market gives us. So there is no target CAGR. We hope to match the market performance somewhat with the original naked put, the step one, kind of get the market returns, and then use the step two, step three, or however many steps below that. When the VIX spikes, use those as our alpha, as our extra profits. And then, as I was starting to say, with this strategy, because of the small number of naked puts, small buying power usage, we can get more money parked into SGOV or BIL or something like that, because we have fewer futures to be facing the overnight liquidities and costs and stuff. So we can, right now I'm at around 90% of the net liq. I'm pretty sure I could get to 95 or even 100% once the strategy gets going and there is no buying power issues or anything. So that's a significant contribution to the overall profits given everything else. But liquidity here is really giving us hard time. So I don't know if we're gonna be able to. We're gonna really have to work this down. Again, we're not too concerned with getting maximum extrinsic value here, but we do want to get some so that we don't get early assignment. Let me see, early assignment. Although I am a bit puzzled by this 59.50 credit and 68.75 credit, and then the mid being 30. I don't know. It probably has to do with futures being different expiration, but if anybody knows why that might be, jump in. All right, finally. So it took us a little while, but we got 1775. Okay, probably that's fair pricing. So equals, we're gonna add 17.75, and then we're also gonna increase the strike because now we had to move to a higher to the next expiration, and it was 5,700. For those of you that joined later, I was just explaining that we had to move higher because we're moving from one futures expiration to the next one where the price is higher. This wouldn't be the case with SPY if you had a portfolio margin, but we don't. So we're stuck with futures. We get to suffer with the liquidity and with these rolling costs. But that's fine. It is what it is. We collected extra premium, and this is now the third roll on this one. And now we get to go back to 24 days. So we are now looking at selling that second one at 54, somewhere at the money or close. But we already have one from the put debit spread here, so we're not going to go there, but we might go here. And this is nice, 467. So if we can get that would be nice. Let's try and let's just go right there. Again, I know we're close to the money here, at the money. That's the plan with this one. For the third one, we would like to be a little bit further out of money. And the third one we would only put if the market starts pulling further on Monday and the VIX jumps higher. That would be really nice. But here we're gonna have to, where is it? All right, we got filled at 94. So let's go 94 and 56. I mean 54.60. 54.60, and then we got 94 quantity one, and oops, no, sorry, I think, oops, what did I do here with my formulas? I clicked something wrong. Damn it. I clicked the wrong button, and let me just go right here and let me go to yesterday just to restore this version. Sorry about that, but we got real quick, we got 1775 plus 1775, and this is the third roll, and we went up to 5,700. Any questions, guys, by the way? So I think it was this one I wanted to click. We got 94. We did one of them, and the strike was 54.60. 54.60. Now we're gonna go and so this is looking good. Now we're gonna go back to test and play with these numbers here just to update our test. Let's do this. So spot strike, it was let me see, 5,700. Then we're gonna have This is actually right around 4% below, but I'm gonna remove this just to see the correct number, 5460. So for the next one, if we get to this neighborhood, which is 10% below here, we would still be our net lick and our leverage would be around 2 at that point, which is acceptable, but that's where we would stop, and then we would start defending once the market goes further below that point. But for right now, we are good. Let me right here. So let's see, net lick 1.18 is our current leverage, given this number and these two naked puts at this exposure. Any questions on that, guys? 1.18. So you can see now why we don't really care if on Monday market plummets another 5% and the VIX goes up. That would be ideal, because then we would get to put another strike here and get some decent premium. And then after that, we would hope that market, slows down. But more often than not, it would, because corrections we faced often, 10%, but it doesn't go past that point too often. Right. Was there anything else? Did I cover everything, guys?
One question. So if it's SPY, the first one you rolled, you would have rolled to the same strike then instead of going down.
If it was SPY,
Yeah.
yes, I would roll to the same strike further out in time, and obviously I would have to move it however far out it's needed to get some extrinsic value so that we can actually do the roll for credit. But it would be the same strike. Here, because it's futures and we deal with this different expirations and different rolls, we're stuck with that.
Okay, thanks.
All right. All right. I think I covered it. I can maybe just it's okay. Actually, we'll be probably going on for 20 minutes or so. I think it's enough for a little video. Hey guys, if you like this video, make sure you like and subscribe. Join our Discord. Link is in the description below. Have a fantastic weekend, and I'll see you all next week. Now, we don't have any trades here scheduled for rolling. We're not going to be rolling these trades for a couple of weeks. So what's going to happen if we lose extrinsic value, especially on the first one, and we might face the assignment, we can consider rolling it out further, or just take the assignment. And then if the market goes down and the VIX goes up, then we're gonna try and shoot our third bullet. And in that case, I will let you know, and we'll do the live video again. All right. Have a fantastic rest of the weekend.